Hello, everyone, and welcome back to the Cougar Crypto Report. I'm your co-host, Tiana. Joining me is my fellow co-host, Michael.
Hi, everyone. I'm Michael, and I'd like to also welcome everyone back to the Cougar Crypto Report. I hope everyone has been doing well and taking care since the last video.
In the last episode, we gave an introduction to cryptocurrencies. We talked about how they were introduced, what technologies they use, and both the advantages and disadvantages of cryptos.
We also talked a little bit about Bitcoin because of its status as the first crypto to be introduced to the world in 2009. In this episode, we will take a deeper look at Bitcoin and why it's been blowing up again.
We will talk a little more about the history of Bitcoin and its peer-to-peer technology, how it compares to fiat currencies that are used today, and also the risks associated with Bitcoin.
And without further ado, let's get this show on the road. Before we get into why everybody from retail to institutional investors are going crazy about Bitcoin, we need to understand where it came from and the journey it's taken to get to this point.
As we mentioned in the last show, Bitcoin was introduced by an anonymous programmer or group of anonymous programmers under the name Satoshi Nakamoto. Nakamoto introduced Bitcoin into the world in 2009.
Bitcoin is a decentralized form of digital cash. Nakamoto at the time described this as a peer-to-peer electronic cash system. This eliminates the need for middlemen like banks and governments to make financial transactions.
According to NerdWallet, Bitcoin does not use any servers and instead relies on a combination of peer-to-peer technology, much like Wikipedia, for example, and cryptography. Cryptography allows users to pass on information that can only be seen by the sender and receiver.
Bitcoin is different from traditional fiat money because Bitcoin is not backed by any items of physical value like gold or silver, and it's not backed by trust in central authorities like the US dollar or the Japanese yen. Bitcoin is currently backed by code. As the price of Bitcoin rises, so does the public interest in buying Bitcoin. Bitcoin's price is based off supply and demand. As the demand rises, so does the price, and once the demand goes down, as does the price as well.
Bitcoin is powered by the blockchain. In the last episode, we discussed how the blockchain is a public ledger that records all transactions made by its users. Blockchain is what powers most cryptocurrencies today.
Bitcoin and other cryptocurrencies are stored on digital wallets. There are two kinds of digital wallets, and they're categorized by either being a hot wallet or a cold wallet.
A hot wallet is where crypto can be stored online through a trusted crypto exchange or provider. This wallet can be accessed through a computer or a smartphone app. You do need an internet connection as well. A cold wallet is where crypto is stored on an encrypted portable device, like a thumb drive. It allows you to download, store, and carry your crypto. One is connected to the internet and one is not.
However, you do need a hot wallet in order to move these cryptos to another cold wallet. These wallets each contain a private and public key. A public key serves as a public address which other people can see and send crypto to. This is comparable to a bank account number.
A private key is comparable to an ATM PIN code. It's meant to be kept secret only to the owners and is used to authorize any transmissions.
Next, we will talk about the peer-to-peer technology Bitcoin uses. It is one of the first digital currencies to use this type of technology to facilitate instant payments. The people that verify these payments or transactions are called miners.
In the last episode, we talked about how important the miners are and how they are in charge of processing transactions. They are motivated by getting paid in crypto as well. This results in the release of new coins. In Bitcoin's case, there can only ever be 21 million Bitcoin that can be mined. As of January 2021, there are over 18 million Bitcoin in existence, with a little more than 2 million left to be mined.
Now we will further discuss how Bitcoin is different from fiat currency. As we brought up before, Bitcoin has a fixed supply value of 21 million Bitcoins. For any fiat currency, most governments have some control over the supply and currency. The most recent example of this is all the stimulus money that was printed due to COVID-19 in the US. Bitcoin's scarcity is something that differentiates it from fiat currency and also gives it some value as well.
Another thing that separates Bitcoin from fiat currencies is its divisibility. Now, what do I mean by that? Well, there are only 21 million Bitcoin that can ever be in circulation. but each Bitcoin is divisible by 8 decimal points, compared to the US dollar's 2 decimal points. These smaller units of Bitcoin are called Satoshis, named after the cryptocurrency's creator. This allows for quadrillions of Satoshis to be in circulation throughout a global economy. Even if the price of Bitcoin keeps rising and rising, everyday users can still participate by having a small fraction of a Bitcoin.
One of the big selling points of Bitcoin and other cryptos in general is the blockchain technology it is powered on. The utility of this blockchain and how it's used as a decentralized, distributed ledger system that doesn't rely on trust in order for the system to work. Blockchain technology is very flexible, meaning that it can be used for things outside of the crypto space as well, like legal contracts or product inventories.
The last difference we will look at will be the transportability of Bitcoin and other cryptos. Bitcoin transactions between two parties take minutes, regardless of how much is moved, regardless of where the two parties are located, and all with very little fees. Compare this to today's current system. What if I sent Michael $100,000? It would take days to clear and have high fees.
This is why people look at Bitcoin as a digital gold. It's scarce but divisible, it has good utility, and it's very easy to move and transport. If someone wanted to send $2 million worth of gold somewhere in Europe, the fees and the waiting time for that are not ideal. You're paying for the fees, you're paying for the shipping costs, and you're waiting for it to get there in the first place. If I had $2 million worth of Bitcoin, that transaction is done in 10 minutes and you only pay a small fee.
Next, we will get into some of the risks associated with Bitcoin and other cryptocurrencies. Many people purchase Bitcoin as an investment rather than to use for transactions or as a medium of exchange because of its rising price. The price of Bitcoin has been extremely volatile throughout its history, so it's important to know some of the risks.
Risk number one associated with Bitcoin or any other cryptocurrency in general is regulatory risk from governments. Although governments cannot manipulate the price or circulation of cryptos, they could pass laws or regulations that could outright ban anybody from holding the crypto. Governments argue that Bitcoin and other cryptocurrencies are used for illegal activities, money laundering, or tax evasion. For this reason, some governments around the world have already banned cryptos, and more might implement more regulations. While banning cryptos would not be good, more regulation would make Bitcoin and other cryptos more secure and less volatile.
The next risk we will talk about are security risks. Most people who own cryptos buy them on several exchanges. One of them could be Robinhood. Exchanges are digital, and like any digital system, they are prone to hacking. One example of this was when an exchange by the name of Binance was hacked a couple years back in 2019. The company covered what was lost, but the hackers were able to get around $40 million from the exchange and its users. This is one of the big problems with Bitcoin, because all transactions are final. If there's a problem like hacking, people don't get their crypto unless the exchange covers it, like Binance did. However, they are not required to do so because they are not insured by the federal government. It's always important to bring up the idea of only investing what you're comfortable losing.
The last risk we will bring up is the price volatility of Bitcoin and other cryptos. An example of this is the Bitcoin run in 2017 and 2018. Bitcoin had reached all-time highs of $19,000 in 2017, however had a massive crash down over the next year down to $3,000, which is a staggering 83%. As you could see, the price can move erratically at times, so it's important to understand that to minimize your chance of losing any money.
Looking more recently, Bitcoin has been on a steady climb up and continues to set all-time highs. Just a few days ago, Bitcoin climbed to $50,000 for one coin and will continue to rise throughout the year if interest keeps up.
A big reason why Bitcoin broke past the $50,000 barrier is because not only is there immense interest coming from retail investors like you and me, but because there's also institutional interest as well. This means Fortune 500 companies and banks all over the country and the world. In my opinion, the price will continue rising, especially if more companies follow in the footsteps of Tesla and investing into Bitcoin and putting it on their balance sheet.
Tesla bought $1.5 billion worth of Bitcoin a few weeks ago, around the $35,000 price. According to Market Insider, Tesla's return on their investment just a few weeks later netted them more profit in those few weeks than their entire car sales revenue from the 2020 year. over $700 million. After seeing numbers like that, it's easy to see why other companies are wanting to get involved.
There are some institutions that believe Bitcoin is a digital gold and a hedge against inflation. As the United States prints more money, the value of the dollar goes down with it as well. Companies want to protect their assets, and Bitcoin is a way to protect those assets.
And there we have it, folks. A little introduction to Bitcoin. We talked a little more in depth about Bitcoin's history, its peer-to-peer technology where it can be stored, how it compares to fiat currencies, and the risks associated with it. We hope this clears up some things concerning Bitcoin. Thank you for joining us on this episode of the Cougar Crypto Report. Until next time, I'm your co-host, Tiana.
And I'm your second co-host, Michael. Thank you guys again for joining, and we'll see you again next time. CCR out.